If we want to know what's going to happen in the stock market and the economy, we don't have to look for CNBC information, Bloomberg, and try to get the latest YouTubers' thoughts on it. We only need a few things, and it really comes down to liquidity. Today, I'm going to talk about the first thing. First, we'll go down, and that's important because that deflation gives the government and the central bank authority to stimulate. And we'll look into that, okay? The second thing is that we will then begin to inflate. And I think it's important to follow this through the cycle to be able to determine, as if you have a crystal ball. I'm going to show that to you today. If you stick with me, I will explain everything that the Federal Reserve has said and why that is extremely important to watch. Let's begin. Throughout 2022, we have seen that stocks really took a beating. I'm just trying to show you that back-to-back down years are rare for the stock market. This chart pulled back from the 1970s up until the present. You could see, obviously the green shows us years in the positive, red is in the negative. And looking at 2022, it was down nearly 20%. And you just go through and try to realize for yourself, is the likelihood of 2 years in a row high? And the answer is no. However, what's not being included here is the important information that we need. Number one being liquidity. Prior to that, though, we need to understand what was going on in the 2022, 2021, 2020, and so on, the years prior to this, and trying to figure out what that means for 2023. It is very unusual to see the amount of stimulus provided by both the government and the central bank that they did, and yet this really led up to the moment we're in today. No matter how much they stimulate, it has barely any effect today. So while we could see stimulus, we're going to need a heck of a lot of it in order to give it a real boost. So that's important, okay? I just wanted to show you the history. In fact, we can go all the way back here. I believe that would be 1929 or just prior. All these years, the same kind of thing, okay? Showing us that oftentimes we do not see back-to-back years of a down market. We have to look at the response from the government and the central bank to be able to determine where the stock market will go. We don't need to look at how many cars Tesla sells. We don't need to look at how many iPhones and MacBooks Apple will sell. That's not what's important. Although, of course, that is some of it. That's not important. We need to look at liquidity. You've got the examples here. In this case, they're showing us, will Jeff Bezos come back on as the stock falls down? We need Jeff Bezos at the helm so that he can make the stock go up again. Well, what about what happened with Disney? And they brought the old guy back in, and what happened? The stock initially pops and then it drops. It's not about who's the CEO. It's nothing like this. It's about what's happening overall. You pull liquidity from the system and the stocks can fall. That's it. That's what you need to know. Then I wanted to show you this as well, directly connected with it. Amazon.com said Tuesday it has reached an agreement with lenders for an $8 billion unsecured loan. I wanted to also note that the Bank of China was one of those that gave the loan. Now, you might be thinking, why does Amazon, a $1 trillion company, need a loan? Well, this is the way it works. You see, all of this is financed by debt. All of these companies, they all use debt. But when the debt becomes more expensive, suddenly it's not so attractive. These companies, like the growth companies, especially tech stocks and so on, it's really not as attractive as an investor. We're talking big investment companies and so on. This is what occurs right through the cycle. So as interest rates rise, then we have a sell-off that goes on. And it's as if we're surprised about it. It's as if we're trying to point fingers. Oh, that's the reason, that's the reason. And nobody wants to look at the Federal Reserve. That's the key. That's the important part. Don't ignore it, okay? You could see that Apple has been seen as a flight to safety trade, and when people kind of throw in the towel, that's when they sell Apple. When we reach a bottom, Apple tends to get washed out and cheap, and it's still, if anything, slightly expensive. So this is one stock that had performed better than all the other tech stocks, but even that has been dragged down in more recent months. Then we have this. Wall Street banks are turning bearish on Taiwan Semiconductor Manufacturing Co., TSMC, cautioning that the world's biggest chip maker will issue conservative guidance for its revenue outlook due to weak demand. And that's key, because you look at all these companies, whether it is Apple or others, that utilize all these semiconductors, and now we went from a shortage to a glut, except for, I believe, in the auto industry, okay? So this is really key, because you start to see how these companies are interconnected. The suppliers of Apple, who's supplying Apple? Well, one of those companies might be TSMC. Apple makes a bunch of their own chips as well, which is good because they have more control over the supply chain, but it gives insight. If TSMC says, oh, we don't need as much, we're not going to produce as much, the revenue is going to be lower and so on, that's going to take a hit to their company, those investors. But we realize, oh, really, they're not selling to consumers, they're actually selling to other companies. And so those companies are probably having weaker guidance. They're telling them, oh no, you know how last month we needed 1 million units? We only need 700,000 this time. So it shows us a few things. Now let's look at the next aspect here. Keep your eyes on this. No Fed official expects an interest rate cut to be appropriate this year, according to the meeting minutes. So these came out, okay? And for most people, they might just gloss over this. Okay, sure, whatever. But this is really an extremely important part of what happens during these cycles. Officials want a lot more evidence before they would be confident inflation is coming down. I've got a few things to show you, in fact. Fed minutes show inflation resolve, concern on market views. Officials warn against unwarranted loosening of conditions. That's key, okay? But hold on to your thoughts for just a second here. Look at this. Quote, the Fed is juggling a lot of balls here in the sense that they want to slow the pace of rate increases, but they don't want the market to start a party which would then ease financial conditions. They want to tighten to crush inflation, but they don't want to cause a recession. This is all about the soft landing and so on. Now, let me interject the point right here. The Federal Reserve, their intentions today is to increase interest rates so that we squash inflation. Let's make that clear. And they said in their meeting minutes that they do not want to actually allow investors to think that they're making it, yeah, you know, this is easy, 2023, we're going to start to cut interest rates and so on. The market's pricing in 2023 rate cuts. And the Federal Reserve said in their meeting minutes that that is not going to happen. That's what they said. Multiple members of the Fed made a mention of that here. So please pay attention to this and realize what they're saying. We don't know until they act, but so far we can see that as I've brought you through each and every step of the way, showing you all the FOMC meeting, show you all the statistics that they brought through, things have been, in my view, accurate. So I'm showing you that right now before it happens here in January, and we'll look, further on in. I do believe that you're going to see potentially a 25 basis point rate hike at the next meeting, but that doesn't mean that they necessarily start cutting immediately after. They hold it there, then when a recession hits, then they might wait around and then bring it down. And you might say, well, these things happen in a lag, so they're going to, start to cut earlier than where they believe so that they can get ahead of it. In fact, the Federal Reserve themselves have said that that lag is now much shorter than it was in history. So keep an eye on this stuff. Look, I'm showing you this is the most important speech ever by the Federal Reserve. It is Ben Bernanke, Helicopter Ben. He said this in 2002. This is, you can look this up, okay? Search it online. Deflation, making sure it doesn't happen here. That's the quote. That's the title of it. You could search that. And what he said was, we will do anything to fight deflation. And the example that they used right here was a 40% devaluation of the dollar against gold in 1933, 1934. Imagine your currency right now, instantly overnight, devalued by 40%. They are willing to do this. Ex-Fed Chief Greenspan says U.S. recession is likely. Wages and jobs need to soften for inflation pull back the stick. They want you to be crushed. They want more unemployment, and they want to actually see wages coming down. That's what they're saying. Wage increases, I should say specifically. They want that. What about Fed's Kashgari favors raising rates? Another point, and then pausing. So actually bringing it to, I believe, approximately 5.4%. And that would be enough to slow this all down. We don't know what's happening in the end. We don't know exactly how it's all going to play out. But I can tell you for certain that what we're seeing right now is a time in which we may head down, and then the Federal Reserve turns it on. They inflate and they put your US dollar into the shredder so that it becomes confetti that can rain from the skies. If we see this cycle, it's the same pattern over and over again. I hope I've made myself clear. We go through a deflationary phase where they intentionally do this, they're increasing interest rates, and then it turns around and they rocket up higher. You've got to know how this all unfolds. It is so important. Massive inflation can lead people to invest in assets as a way to protect the value of their wealth. When the value of money decreases rapidly due to high inflation, the purchasing power of that money also decreases. This means that it takes more money to buy the same goods and services, which can erode the value of people's savings and incomes. One example of this phenomenon is the hyperinflation that occurred in Weimar Germany in the 1920s. During this time, the value of the German currency, the mark, plummeted as a result of the government printing large amounts of money to pay for the costs of World War I and other government spending. As the value of the mark declined, people began to lose confidence in the currency and started to look for other ways to protect their wealth. One way that people tried to preserve their wealth was by investing in assets such as real estate, precious metals, and foreign currencies, which were perceived as being more stable and less vulnerable to devaluation. Some people also started to trade in their currency for tangible items such as food, clothing, and other necessities, as these items retained some value even as the currency lost its purchasing power. In general, during periods of high inflation, people may seek to invest in assets as a way to protect the value of their wealth and to maintain their purchasing power. This is exactly what I've been talking about all along. Yes, you can invest in assets in one way, but look at the history and realize that time and time again, people are actually then investing in anything because the currency devalues so rapidly. We don't want to find ourselves in that same situation. Hopefully it won't get to that point, but we need to be prepared today. Did you find this video informative? Was it interesting to you? Hit that subscribe button down below, and tomorrow I'm going to bring you another great one. Take care.